Did you know there's hidden risks behind buying option leaps that most people aren't even aware of? Well, if you've ever bought a call option leap and you go, let's say 400 days out, you might think, hey, this is a great idea. I can be in the position for 400 days or longer. And now I don't have as much exposure as I would with a stock and my downside is limited. But there is a trade-off. For in the market, anytime there's, hey, something beneficial, there's always a gotcha. For every gimme, there's a gotcha. And in this case, there's some inherent problems that most people aren't aware of. And I'm going to share with you some of those insights right here in just a minute. Now, if you don't know me, I'm Sasha, the options coach. I've been teaching people to trade options over the last decade, and I've done things from classes to even writing some books. And one of the latest things that we've got in our class that we talked about was atomic leaps, like the smarter way to go out and buy some options. Now, I'll give you a little bit of a taste and insight of what we've discussed and talked about here in our class. But in other words, one of the bigger issues that most people are not aware of when buying an option leap is that there's a huge Vega problem that goes along with it. So let's say I'm going into a stock like Nvidia. It's very popular. You know, there's a lot of option contracts on there, but you might say, look, I don't want to go into that stock and buy a whole bunch of shares. So I'm going to go out about 454 days out and go to this, in this case, June 18th option contracts, and I will scroll down and buy an option leap. And what I'm going to do is I'll buy the 130. So in this case now, I can pay a premium for this where I can get exposure to the stock. And if it moves, this is fantastic and great. And most people think that this is the appropriate way to do this because now you bought a call option. You don't have to pay as much for the stock. And in theory, you could say this argument is not wrong. However, there's a risk that most people are not aware of. That when it comes to trading options, you're making money from three different ways. Either the delta over here, the theta, or the Vega. So in these cases, these Greeks symbolize your risks, but they are also your money makers. So you're making money from price risk or price movement, time risk or time movement, and volatility risk. Now, what this all means is that delta in this case is one of the biggest Greeks that you have. And the delta means that if the stock goes up $1, you make about $57 for every dollar move it goes up. However, your next biggest Greek is the Vega that most people do not consider, and they're not even aware of it. They don't even take that into account. But look how closely related it is to the delta. They're almost 1-in-1, where this trade is nearly or almost a Vega-based trade. In fact, if I move some of these options a little bit further, let's say I go to maybe a 140 right here, what you'll find is now the delta is almost identical to the Vega. And if I go to 145, look, this delta is 49, but the Vega is actually bigger. This trade has actually become a Vega-based trade, which is something that, you know, for a lot of people, it's like, oh, what does that mean? I mean, I want the stock to go up. But here's what that means, is that now, as this position moves forward, and as this stock actually climbs, think of what happens to volatility as stock prices go higher. The fear, in fact, collapses. And what you've done is you've bought insurance or you've bought an option. But if now the demand for insurance goes down, what happens then is then the volatility in this case also goes down. So what this means is as we bump this down, okay, you've actually lost quite a bit of your profits. So yes, you're still profitable, but you've just skimmed a bunch of it. And this happens to a lot of people, is that as that stock price heads higher, you might feel like you're up $684, but as you compress the Vega a little bit more, you're actually losing and bleeding money. Not only that, you also have the time decay that starts to kick in right there. And now you're thinking, hey, well, I would have made a boatload of money, but really it comes down to maybe you're making slim or none or breaking even. So it really depends on the ratio or the relationship of that delta to that Vega position, and in which case then you might actually have been better off with buying the stock because you don't have this extra variable to account for. Because when we have something like this, that's a big issue. Now you've got your Vega fighting against your delta. Now, if we go to a shorter duration over here and we go to, let's say, June 25th, and now we bring it in a little bit closer because since we don't have as much range, you can see now the delta to the Vega is a 1-to-2 ratio, meaning twice the Vega will be about the delta. Not exact, but we have a 1-to-2 ratio here, whereas before we had almost a 1-to-1 ratio. And this makes things a lot more manageable, that the Vega is less in control and the delta is more in control. But if we go back to something further out in time where the Vega and the delta both of these are very similar in nature, there is something that we can do. And this is one of the things that we covered in the class. And by the way, if you have questions regarding some of the classes that we have, because we've done a ton of classes, just reach out on our website, let me know, and we'll hook you up and give you some insight about the classes, because we do a bunch of classes pretty much every month. We've got some new classes coming out. Anyways, what we can do here is offset some of these things by selling a call against it at an upper level. So let's say we sell this call at a higher level. And now what that will do is trim that Vega. Now we've kind of converted it now to a longer duration vertical, but look at our Vega now compared to our Delta, 36 to 12, okay? Rather than what we had before was a 57 to a 51. So you can see there's a big difference here that just by simply selling something small as a call option above it allows our volatility levels to go down and have less of an impact on those positions. So that's really what you want to think about and look at as you're starting to see the leaps that go in on the process, because you want to minimize that Vega issue or problem. Now, the downside, of course, here is if the stock jumps and goes to the moon, you don't make as much. But of course, as it keeps trending higher, 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 you could go out and get another leap and repeat the process. If you decided to say, hey, well, I might actually, lose the stock, or it's going beyond that short call, because you've got a lot of room. You've got a lot of range for this stock. In this case, from about 120 to about 220, I mean, you've got 100 points of room where this stock can move in the next year. So my point here being is that the trade-off for selling off that call is very beneficial to cut the Vega. Not only that, is that now you've actually reduced your max loss instead of buying a single call for $2,300 or so. And you sell this call against it, right? So we sell $6 worth. We reduce our loss to about $1,700 on that position. It also cuts our theta to about a -1, because if I didn't have it, it would be a -3. Not that that's as big of a deal as the Vega, but you can see it's all helping impact those positions. Anyways, I hope that helps, gives you a little bit of insight. If you're serious and interested about some of the classes we've got, definitely reach out on our website. Send me a note, send me a message here on social media if you're watching these things. And if you're on YouTube, definitely go to our website, because on YouTube, we can't interact as well. So thanks for joining me. Truly appreciate it. If you've got questions, look forward to hearing from you. Other than that, enjoy the videos, and I will see you next time.